Hi, Martin Turner here. This week, John McGrath leads our lecture as we look at liabilities. John introduces us to what liabilities are, where we have a past event, present obligation, and future outflow embodying economic resources. We then look at current and non-current liabilities and various types of liabilities. Unearned revenue, employee benefits, GST collections, long-term debt, provisions, warranties, and contingent liabilities. We also look at liquidity and financial stability ratios. Let's start by looking at what liabilities are.
All right. If you haven't already done so, please click on the Echo 360 link in week 9 of the Moodle site so that you can follow the presentations we go through. Today we're going to do liabilities. We're going to talk about liabilities. But before we do that, let's warm up with a little bit of revision. I think we will. There we go. A little bit of revision. So you need to decide which of the 4 costs there is not recorded as part of the cost of the building, i.e. which cost is not capitalised. I've got one so far. Adam tells me it's him.
I get it wrong.
If the teaching staff could encourage their students to participate, that would be great. Aha. Now I've got 2. Looking for a few more. 3. I'm not sure how many we've got scattered around the campuses. It doesn't sound like we've got too many at this stage.
Oh, John, it's Maria and Mackay. My students are all late this morning. I know one is definitely coming and I'm not sure where the other 3 are.
Okay.
But there's also nobody on Zoom as well, so I'm not sure if we've got too many at all.
Okay, all right. So we'll just go with 3 at this stage. So the answers are 1 for A and 2 for D. Let's have a look at the answer. And the answer is A. And Adam's jumping, almost jumping out of his seat. He reckons he got it right. A real estate commission is a cost that's directly related to the purchase of the building, and therefore it would be capitalised. But annual building maintenance is not capitalised, it's an expense, because it does not add or extend the useful life of the building. Okay, and that's why it is an expense and not capitalised. Okay, let's have a look at the next one. And now we've got 3 who are participating. So, okay, 1 more to come. I've got a fair scattering here. Let's have a look at the correct answer. And the correct answer is A. Now, capital expenditure is an asset, and and therefore you would debit an asset. Remember the extended accounting equation? Assets plus expenses equals equity plus revenue plus liabilities. Debits on the left, credits on the right. Okay, so it's debit and asset. Next one. One more to go. It's fine for you to have a chat to the teaching staff about the answer. It's a learning exercise. You're not getting marks for it. It's not about being right or wrong. So we've got, oh boy, we have a real spread here. Correct answer is reducing balance method. The reducing balance method is because of the way the reducing balance method, the methodology of it, is that more of the depreciation is debited in the early part of the life of the asset and less in its later life. And so it's the reducing balance method. And it's they actually call it the reducing balance method because that's how that method actually operates. The balance of the asset, the amount that is debited to depreciation or cumulative depreciation over time each year is lesser than the year before. So the answer there is B. Now, just summarising those three questions, it suggests that there needs to be, you need to go back and have a look at that particular unit where these questions, particular week where these questions come from, because it suggests there's not an ideal understanding of that particular topic. Okay, let's move on. Liabilities. That's what we're discussing this week. And how do you define liabilities? Well, Martin did a short video that I thought was really great. And he suggested that we talk about this definition of liabilities in terms of past, present, and future, and not as it's actually presented on the screen there now. The way it's presented on the screen now follows the definition as per the conceptual framework. But I thought Martin's idea was very good because it's easy to remember: past, present, future. It's an obligation that resulted from a past event. That obligation is present, i.e. it's not future. And the satisfaction of that obligation is expected to result in future outflow of resources embodying economic benefits. Past, present, future. It's a great way to remember the definition. Okay, let's put liabilities in accounting context. Liabilities are normally a credit. Remember the accounting jingle: debits on the left, credits on the right. And whenever we're thinking about an accounting transaction, it's good methodology to always frame it in terms of the extended accounting equation. And do that every time, and then it becomes second nature. And we all know, by now, we should all know what it is. Assets plus expenses equals equity plus revenue plus liabilities. And as you can see from the extended accounting equation, the liabilities are on the right. Now, that obligation may be illegal or constructive. And what we mean by legal means that generally encapsulated in a contract or a statutory obligation. And this contractual form, an example of that would be a sales invoice, where you purchase goods and you are given a sales invoice. That is a contractual document of that sale. So that would be an example of a contractual obligation. The statutory obligation, an example of that from a legal perspective, would be the obligation to collect and pay GST to the Australian Tax Office. Every business that's registered for GST has that statutory obligation to collect and pay GST to the ATO. A contractive obligation, a good example of that would be where a company has a warranty policy, but it finds out that it has an abnormal amount of defects beyond the warranty period. Now, paying provision for warranty is a contractual obligation, but it's only that contractual obligation only lasts as long as the warranty period. So anything outside the warranty period would not be contractual. In other words, it's the company just decides that in order to maintain good business relations, to maintain their reputation, that they would pay for any defective product outside of the warranty period. And that's not actually all that abnormal, because business reputations are really important, because if we haven't got a reputation, then sooner or later you run out of customers. Now, when do we recognise liabilities, i.e. when do we take them up in the accounts? And we do that when the future economic benefit that will flow from the entity is probable. Now, probable means that there's more than a 50% chance that is going to happen. And the other recognition criteria is that the cost or value can be reliably measured or estimated. Now, you see there that this probable outflow of economic benefits can be on demand, on a specified date, or on the occurrence of a specified event. Now, an example of on demand would be a promissory note, where the payee of the promissory note can demand payment at any time, i.e. on demand. An example of on a specified date would be a purchase made on credit, where, and typically credit terms for accounts payable are 30 days from the date of the invoice. From the date of the invoice, then the liability is due to be paid. So that's an example of payment on a specified date. And on the occurrence of a specified event, again, we can talk in terms of warranty. Payment would be made when it could be shown that the product is defective, i.e. is covered by the warranty policy and within the warranty period. Okay. Now, as we've seen here, the cost or value has to be reliably measured or estimated, and depending on when it is payable, due to be paid, the liability may be discounted. Okay. So what does recognition avoid? Well, it avoids the understatement of liabilities and the overstatement of equity. Classification of liabilities. Well, they're classified according to their amount, nature and timing. And their classification is driven by the need for users to understand the financial statements. They want to know how soon the liabilities on the financial statements are due to be paid. They're interested in the liquidity of the business. And let's have a look at this concept of classification according to amount, nature and timing by looking at the next slide. And here we have a section of the balance sheet, the liabilities section. And so classification according to amount, you can see the amounts here. According to nature, you see these accounts there and this one here are all of different natures. One's an accounts payable, or trade payable, one is salaries payable, allowance payable, unearned revenue, provisions, etc. Different natures of liabilities. And you'll see that they're split into current and non-current sections on the balance sheet. If they're in the current section, it means that they are payable within 12 months from the reporting date. If they are in the non-current section of the balance sheet, it means they are payable beyond 12 months from the reporting date. Now, that's not the only way that the liability section of the balance sheet can be set up, i.e. according to current and non-current. But they can also be set up according to liquidity. And Martin, when you listen to his videos and read the study guide, you'll know already that his example company, Ryman, is set up according to liquidity. It's not set up according to current and non-current. And when liabilities are set up according to liquidity, it means that they are ranked according to when they are payable. It generally means that the liabilities that would normally be in the current liabilities section would appear early in the list, and those in the non-current section will appear late in the list. They're ranked according to their liquidity or when they are expected to be paid.
Oh, sorry to interrupt. If the person with their mic on, could you just please turn it off? That would be great. Thanks.
Yeah, Martin, they've just done it. It was one of the Zoom. We've got 2 people on Zoom now. It was just somebody that had just joined. I've just sent them a message and they've just muted it.
Welcome to those who just came on Zoom. Now, just to going back to the previous slide, as far as current liabilities are concerned, as we said, the current liabilities are due to be settled within 12 months from the reporting date or within the operating cycle if that operating cycle is more than 12 months from the reporting date. Okay, that's the only caveat there. But just remember that the classification categories on the balance sheet don't have to be current and non-current. They can be according to liquidity as well. Now, examples of current liabilities, we looked at the previous slide and we saw there was accounts payable, or was also called trade creditors, and its amounts owed for purchase of inventory, supplies and services as part of the business operating cycle. And the business operating cycle is the amount of time that it takes to convert inventory into cash. Another example is bills payable, which are a more formalised way, more formalised than accounts payable, which are generally typically paid within 30 days from date of invoice. Bills payable tend to be for more extended periods and not always, but generally for larger amounts of money. And they're in the trade, they're called trade bills or commercial bills. And they can also be evidenced in a document called a promissory note, which we also talked about before. The difference between, as I said, are generally the much larger amounts of money, and also there is an interest component to a bill payable that is not part of accounts payable. Okay, accounts payable within the accounts payable terms are normally interest-free. Now, if it's not a current liability, then it's a non-current, and they are due for payment more than 1 year from the reporting date, and there's various types of non-current liability, and there's a list there on the screen. And as you go through, everyone's got their own company, and you'll all have different discrete natures of liabilities, both current and non-current. This is just an example. Okay, your turn. And with our 2 new arrivals on Zoom, we know we've got at least 5 students now. I have to think about this one a little bit because I should talk about that when you see the answers. It doesn't give you another option. It only gives you one option, really. One more. We've got 4. We need another one. Great. Excellent. Well, you're all very right or all very wrong. I'm willing to bet you're all very right. And of course you are. So no need to talk about that one. Well done. Another one. If you go back to the section of the balance sheet that we had on one of the earlier slides, you will actually see a liability there in the current liability section called Unearned Revenue. Okay, got a bit of a scatter there. I pretty much gave the answer a minute ago. It's D, it's current liability. And we'll just go back to that slide. Unearned revenue is there, $1,650. Unearned revenue is money received where the business has not yet transferred the goods or delivered the service, and the buyer has not taken control of the goods or received the service. Okay, so it's a liability. Okay. Employee benefits. Employee benefits are a liability, and they're basically accruals. All forms of consideration given by an entity in exchange for services rendered by employees. And there's two measurement methods, could be short or long term. Short term are recorded at their nominal or undiscounted value, and long term liabilities are recorded at their present or discounted amount. They're recorded at their present value. Employee benefits include wages and salaries. We're all familiar with those. Long service leave, sick leave, annual leave, maternity leave, superannuation, fringe benefits, which could be monetary and non-monetary. Anyone who's done any sort of work, casual work, etc., knows all about wages and salaries. So how is it a liability? Well, it's a liability until it is paid. So when the employee puts in the time and earns their salary or their wage, they are accruing the firm owes them for the wages and salaries until they are paid. Quite often, people are paid on a fortnightly or monthly basis, and until they are paid, then what is owed to them because of services rendered is accrued in the accounts. And by doing so, by recognising that accrual you are recognising a liability. Long service leave, sick leave, annual leave, maternity leave. Most people will be familiar with those. Maybe not everyone with maternity leave. Superannuation post-employment benefits. Again, there's a compulsory superannuation amount that the employer has to set aside for employees in Australia. So there's a liability for that. And any fringe benefits, an example of a non-monetary fringe benefit would be a company-provided car or car parking, etc. Okay. So how are employee benefits recorded in the accounts? Well, there's a typical week's worth of wages and salaries, and we've got $3,650 worth. But from wages and salaries, and for anyone who actually has worked, they know that tax will be taken out, and the company, what the company is doing is collecting that taxation on behalf of the ATO. That is a statutory liability. So on this side, we've got all the liabilities. This is a liability to the tax office. This is a liability to superannuation fund, the insurance company, the private medical fund, and the liability to the employee for the net of the gross salary and the deductions. Now, some of the deductions are compulsory, no choice, i.e. the company has to deduct tax from your wage or salary. Superannuation fund, that could be either voluntary through a salary sacrifice, or it could be that the employment terms that you have with your employer is that, as well as the employer contributing to superannuation, the employee is also expected to contribute. It depends. So that's part of the employment contract, maybe, or it could be voluntary. XY Insurance Limited, that is where the employee gives a written authority to the employer to deduct money and pay it to XY Insurance Limited. Similarly for FM Medical Fund. Okay, but they're all liabilities that are created either through statutory means or through the employee authorising the employer to deduct them and pay them on their behalf. You also will know that there's also employee ancillary costs that are accrued. Now, annual leave, sick leave, maternity leave, workers' compensation, public holidays, and long service leave. In Australia, employers must, for permanent employees, provide 4 weeks annual leave. They must, for permanent employees, must provide sick leave. Also must provide maternity leave, workers' compensation, that is a statutory obligation on behalf of the employer to provide workers' compensation insurance, and in Queensland is through WorkCover Queensland. Public holidays, for gazetted public holidays, the employer must provide those for an employee. And long service leave, there's 8.667 weeks worth of long service leave entitlement after 10 years of continuous service for permanent employees. Annual leave and sick leave are not payable to casual employees, and the reason for that is the casual rate is increased. It compensates for the fact that employees aren't paid annual leave or sick leave. So it's only to permanent employees. Okay, that's the background on it. The journal entry is an amount is accrued to annual leave payable for, in this case, annual leave, and the debit is to annual leave expense. But the liability is an accrual to an account called annual leave payable. And similarly for the rest of these ancillary payroll costs. We talked about statutory obligations before, and GST Collections is one of those. And when a sale is made, the accounts on credit, the accounts receivable amount includes GST. Okay, it's paid by the purchaser. The sale amount excludes GST because the GST is put in an account called GST Collections. The money is collected by the business on behalf of the Australian Tax Office. But at the same time, the Tax Office allows businesses to deduct what is called an input credit, and that's the GST that's associated with any purchases that the business makes. And so when it comes to the end of the quarter, when the settlement date is due for GST, then it is the net of GST collections and input credits that is payable to the ATO. And that's this figure here, cash at bank, 120. Okay, but in terms of this whole transaction here, if you like, from a liabilities point of view, the liability is GST collections, and it is a statutory obligation. Every business that's registered for GST must collect GST for the ATO. Okay, your turn. One more. Excellent. Okay. We've got B. The B's appear to have it. 4 for B, 1 for D. And D says debit salary expense for 4,800, credit salary payable 4,800. Now clearly the 4,800 is correct because it's 3/5 of 8,000, and debit expense, credit salaries payable. Now, it can't be a credit to salary expense because expenses are normally a debit. So that pretty much gives that one away. Okay. Next one. Okay. All of the above. 5. Everyone's gone for all of the above. Good choice. Well done. Next one. I think it's in answering this one, think about pretty well every topic that we've covered from week 1. This issue of internal control, and there is a factor there that's common, pretty much common to all of them. One to go. Well done. Now we've got a real scattering here. The thing to remember here is that whenever you're talking about internal control, separation of duties is at the core of it. And the reason it's at the core of it is because what it attempts to do, at least, is that it prevents the person who perpetrated the fraud, it prevents them from covering it up. Okay? And that's why separating payroll duties is the answer there. That is central to internal control, separation of duties. Okay, so the person who records the wages payable is not the same person who prepares the payroll. It's not the same person who prepares the entries into the accounts. What you don't want is a person who prepares the payroll to set up a dummy employee and to pay that dummy employee's wages into their accounts, i.e. the person who is preparing the payroll. And it happens in businesses who don't have separation of duties. Even the most honest employees will be tempted if the internal controls in the business are slack. And there's all sorts of reason for that, and it's well researched. So the answer is, of course, B. Another one. This one's clearly making people think. Okay. Real spread here. The answer is C. So we're talking about a cash sale of $200,000 plus GST of 10%. Okay, and just as if it was a credit sale, if it was a credit sale, then the accounts receivable would include GST. Well, similarly, whereas a cash sale, the amount of cash that's collected would include the 10% GST. And the credit is GST Collections 20,000 and credit sales of 200,000. Remember, sales does not include GST, which it doesn't. The amount collected does include GST because it has to be, the GST component has to be sent on to the ATO, and that a component that has to be sent on the ATO is a liability, and it's a statutory liability for the 10%. So it's credit, GST Collections. Credit, a liability. Okay. So, okay, again, we have C, gets the majority of the votes, with a bit of a scattering elsewhere. Let's see if C, the C's have it. And the C's, in fact, do have it. All right, so it's GST payable of $10,000. We have cash sales of 100,000. It's a cash sale. It has GST component of 10% of $100,000, which is $10,000. So what current liability does the sale create? Well, it's the statutory liability called GST, and it's for the amount of $10,000, which is 10% of the $100,000 cash sale. I think we probably got that by now. All right, and that was interesting, that bunch of questions. They did make you think, and the purpose of the questions was to make you think. But at the end of the process, by seeing the answers, and nobody knows who gave what answer, and it doesn't matter, it's all about a learning process. So if, in fact, you are learning as a result of this question and answer process, then that is what it's all about. So that was great. Why finance through long-term debt as opposed to financing through equity? That's the implication of the question. Well, because long-term debt has some advantages, but it also has some disadvantages relative to equity. Advantages are creditors do not have voting rights, as shareholders do. Creditors do not share excess profits. They only get the interest that they're entitled to contractually. Owners can receive, or shareholders can receive, greater return if more shares are not issued. When more shares are issued, then the shareholding is what's called diluted, and particularly if there's not a rights issue, i.e. the shareholders can't buy more shares in proportion to the shares that they already hold. The disadvantages from a business perspective is that you have to pay interest on long-term debt regardless of how well the business performs. There's default risk. If you can't pay, then your lender, under the lending provisions, covenants, can wind you up, and that's pretty sad. And creditors get paid first in the event of a business wind-up. Shareholders are at the end of the list. They get paid last. So why are we even talking about this? Well, we're going through a period of unprecedented low interest rates. And so borrowing has probably never been more attractive now relative to issuing shares. Shareholders, people on term deposits right now can get, right now, 1.8% if they're lucky. Others are getting 1.5% depending on the terms. And so people are piling into the share market because the share market is giving a return of about 5%. And so borrowing money is in fact never been cheaper. But there's risk. There's always a trade-off. And if you borrow too much, then the business becomes becoming unstable. And you end up losing everything because of default risk. And that's not very attractive. Question? One to go, unless someone dropped out of the we're there, still there. Ooh. The A's have everyone's gone for A. Does the A's have it? And the A's do have it, which means we don't have to talk about it. Which is really good, which means we're really starting to get into the groove now. When we got 100% with the answer correct, we're starting to get into a sweet spot. Provisions. Provisions are a special type of liability. They're special because they are uncertain as to timing or amount. Now you'll see on the slide there, we're talking about accumulated depreciation and allowance for doubtful debts. And they're saying they're not provisions. And you'll remember from previous lectures that accumulated depreciation and allowance for doubtful debts are what is called a contra account. Now the reason that we're even discussing them is because they are a credit balance. They are normally a credit, the accumulated depreciation and allowance for doubtful debts. And they're normally a credit because of the sign of their companion account. In the case of accumulated depreciation, the companion account would be an asset account, perhaps the buildings, perhaps property, plant and equipment. And for allowance for doubtful debts, the companion account is a debit called accounts receivable. Okay. Well, even though they are accumulated depreciation and allowance for doubtful debts are credit accounts, they are normally credits, they are not provisions. Okay. They are a special type of account called contra accounts because their value is contraed or set off against their companion account in the balance sheet. Okay. Now, examples of provisions are long service leave, which we talked about before, and provision for warranties. Items that are not provisions are future expected outlays, and the reason they're not provision is because there is no present obligation. If it's a future expected outlay, then it follows that there is no present obligation. And a good example of that is self-insurance. Now, as insurance costs go up, then some businesses decide not to take out insurance through an insurance broker. They actually decide to run the risk of an insurable event themselves. They run the risk of a fire, flood, theft, whatever, because of the cost of insurance. Now, that self-insurance is not a provision. It's because there is no present obligation. The liability, if you like, hasn't occurred, right? So there is no present obligation. Now, provision in accounting context. In Martin's videos, he goes to great lengths to talk about the fact that provision does not mean that cash is explicitly set aside for that provision, whatever it may be, warranty, long service leave, etc. If you think of a squirrel gathering acorns and putting them away in its burrow for winter, that's not happening, all right? The cash is not being put away for that provision. It's not being put away for winter or a rainy day. It just does not happen that way. Provision in accounting context, in fact, means provisional. And it's provisional because the liability is uncertain as to timing or amount. That's the reason it's provisional. Okay, it doesn't mean that cash is put aside explicitly for that provision. And it's tempting to think of a provision as cash being put aside, but in fact that is not the case. Warranties, estimate of future warranty obligations for inventory sold. We've all bought stuff from Harvey Norman, from JB Hi-Fi. When we buy stuff from those companies, we get warranty. 12 months, generally 12 months, can be more. You can actually buy an extended warranty for a lot of products, particularly through Harvey Norman. They offer you extended warranty. So you can enter into a warranty contract for a longer period than normal. The entry when goods are sold, and because when they're sold, then warranty is attached to that sale, and under the matching principle, as we make the sale, we must also provide for the warranty that attaches to that sale. And so it's debit warranty expense, provision for warranties. That is the liability, or the provision, sorry, and the provision is a particular type of liability. And when the product becomes defective, then provision for warranty is debited and the customer is paid, cash at bank. Okay, so that's the complete the entries that are associated with warranty. Now, we talked about before that sometimes a business will actually pay a customer for a defective product outside the warranty period. If it's outside the warranty period, then it's not covered by the provision for warranty, and it is then not a contractual obligation on behalf of the firm. It is then a constructive obligation. The firm is paying it to maintain its reputation. Question? This question is designed to make you think about what we've been discussing this morning so far. next one, 6. Okay, who have we got? Oh, we've got a real scatter here. Interesting. Let's have a look at the answer. The answer is C. In fact, we have a we haven't got a minority of C, but it's certainly not the majority. 3 have gone for D. Now, a present obligation of uncertain amounts should be. Remember we said before that a provision is a special type of liability. And for it to be a liability, it needs to be a present obligation. Our uncertain amounts, remember a provision is, let's go back to it. It is, one more. Our liabilities of uncertain timing or amount. Okay, that's what a provision is. And so we have a liability, a present obligation of uncertain amount. And therefore, it is reported on the balance sheet. It's reported in the liabilities section of the balance sheet. Okay? I thought that would make everyone think. Next one. To do this one, get the answer to this one, you have to remember the journal entries that we had before the warranties journal entry. The two components of it. D's have gone for it. Okay, let's see if the D's have it. The D's, in fact, do have it. And for those who went for A, the solution to the question is we have warranty payable of $1,000 at the end of 2017. We have a warranty provision for sales made during the period of 3% of 100,000, which is 3,000. So we've got a bank of warranty provision of 4,000, and we paid out warranty for defective product for 2,500. 2,500 from 4,000 gives 1,500. Okay, now we go on to another type transaction called a contingent liability. And just when you thought you really had this all sorted out and nailed, we're talking about a contingent liability, which in fact is not a liability at all. But through usage, through custom, it's called a contingent liability, this particular transaction. And a contingent liability arises when conditions exist at balance date where uncertainty exists as to outcome and valuation, or both. The reason it is not a liability, a contingent liability is actually not a liability, is because there is no present obligation, okay, because of these two factors here, uncertainty as to outcome or valuation. The future event is beyond the entity's control, and there's examples here of lawsuits, guarantee and indemnity. Now, lawsuit, of course, and there's no present obligation until the lawsuit is settled. And that's why there's no present obligation. And for a guarantee, difference between a guarantee and an indemnity is in a guarantee there are three parties: the guarantor, the finance company that provided the money, the finance, and the person who received the finance. And you might think about it in really simple terms. Dad goes guarantee for the son to purchase a car on finance. Okay, three parties involved, but the guarantee, it's no present obligation until the guarantee is triggered, i.e., the son or the hasn't paid for the car to the finance company, and then the father has to come in and pay the finance company on the son's behalf. Okay, but that doesn't happen until a guarantee event is triggered. Indemnity, there's only two parties where one party indemnifies another against a loss. Okay, only two parties involved. That's the distinction. But indemnity, again, doesn't come into play, i.e. there's no present obligation until there is an indemnifiable event. Okay, contingent liabilities are disclosed in the notes of the financial accounts. They are not taken up into the body of the accounts at all, only in the notes. And this is a flowchart of to separate provisions from contingent liabilities from the event where you don't do anything at all. And it's a really handy little flowchart. And it start off: is there a present obligation? Yes. Is there a probable outflow? Is more than 50% chance of the future outflow of benefits flowing? Yes. Can it be reliably measured? Yes. Then it is a provision. If there's no present obligation, but there's a possible obligation, yes. Then is that obligation remote? No. Then it is a contingent liability. If there is no to possible obligation, or if it's remote, then you do nothing at all. Not in the accounts, not in the notes, nothing. It's a good little flowchart. Okay, analysing liabilities for decision making. As I said before, users of financial accounts are interested in the liquidity of the business they're looking at. And analysts do, and users of financial accounts do a number of very straightforward ratios to get a handle on short-term liquidity and long-term stability. In this slide here, we're talking about short-term liquidity. And the traditional ratio used is current ratio, where we're looking at for every dollar of current liabilities, how many dollars of current assets do we have to cover that $1 of current liability? Rule of thumb is the current ratio should be about 2, nice and comfortable. Less than 2, I'm starting to get a bit worried, but it depends on the industry. It's not a generalisation. It depends on the industry, but typically 2 is nice and comfortable. Quick or asset test ratio, if these current liabilities have to be settled in a hurry, then only certain assets, current assets, are taken in consideration. Cash at bank, marketable securities, net receivables. And they're all assets that can be converted into cash, are already cash, or can be converted into cash quickly. You'll note that the asset that's not appearing on the numerator, on the top line there, is inventories, and because it takes time to convert inventories into cash. Rule of thumb, the quick ratio should be around 1. So, okay, 2 for current, 1 for quick. Looking at the longer-term stability of a company, a couple of ratios I've looked at are debt ratio. For every, the debt ratio for every dollar of assets, how many dollars or parts of a dollar have been funded by liabilities, as opposed to equity, which is the equity ratio. Okay. Again, if there's too much liabilities, then the company can become unstable in the event of a shock, an unexpected shock, like the GFC. Okay, remember those ratios, because you'll need them to do this question. One more. We have it. Ooh. We are getting into the groove. We've got 6 for A. Do the A's have it? The A's indeed do have it. And of course the answer was current assets over current liabilities. And we don't need to depth that because everyone got it right. Okay. What's the most important thing you learned today? Now, it's a rare day where you don't learn anything at all. I really like days where I learn at least something new. If you open your mind to what's happening around you, normally there's something new to learn. No matter how old you are. We have 6 participants and we've only got 3 answers so far. 4. I am genuinely interested in what everyone learnt today. Okay, we'll have a look at the 4 so far. More in-depth clarification of liabilities. Well, that's excellent. We need to understand liabilities. When a business owes money or you owe money personally, it's quite important to understand all the ramifications of liabilities. So that's great. Second one, that I need to review liabilities to gain a deeper understanding. Yes, don't expect to know everything about a topic at first brush. You need to read, think about, and reread, because when you reread, you find something that you didn't gather before. And to read with an inquiring mind is really important. It's really good to question what you're reading, to relate it to what you already know, as everyone has learnt through ACCT 1059, the process of learning. Provision need to be allowed for, despite being uncertain in their timing and amount. Yes, true, and the reason for that is that they are a special type of liability, and therefore they need to be accounted for. Meaning of liabilities and their presentation. Meaning of provision and current liabilities. All right? Oh, that's all good. The whole process of this 1.5 hours was to develop that meaning to the extent that we can in that period of time, and for you to follow it up in the workshop and in your revision. Okay, we've still only got 6. I've still only got 4. Okay. We'll go on to the next. What questions still remain unanswered? It's really important for you to work your way through the study guide for liabilities. It's quite comprehensive. It's also important for you to, particularly as part of your revision, and to listen to the videos that Martin has recorded. They're short videos. They're no more than 5 minutes, some less than that. But what they do is they go to the core of the issues that are covered in the study guide. And they are a really good learning tool. So I really encourage you to do that, both the study guide and the videos. What questions still remain answered? I'm actually very encouraged by the fact there's only 1 so far, but intuitively I believe there's going to be more than that. More questions still remain unanswered from this topic, because you simply can't cover everything in an hour and a bit less than an hour and a half. Let's have a look at the one that's there now. What provisions are and they are not backed by cash? remain unanswered. What provisions are? Well, provisions are a special type of liability. They are an obligation that present obligation that are uncertain as to timing and amount. That's what a provision is. And they're not backed by cash. The point there is that, in fact, they are not backed by cash. That is not the reality. They are not like a squirrel putting acorns away for winter. There is no cash explicitly put in quarantined in a special account for that provision. Even though the word provision tends to suggest to you that that is what is happening. In fact, that is not happening. Just like every other liability, the payment for that liability comes out of the collective pool of resources that are available to the company. Liabilities are not only paid for by cash, they can be paid for with an asset, exchange of asset. That can be paid. They can be exchanged for another liability. They can be exchanged for equity. There are all sorts of ways of discharging a liability. It's not always by cash, and that helps to get away from this idea that a provision is backed by cash. Do we have any more? Would the teaching team like to add anything to the discussion on this topic today?
Oh, I think you've done a fantastic job, John. It's Maria and Mackay. I just wanted to point out to students to make sure that they are reading the study guide for this week as well. So that's Chapter 6, which is what you've based your lecture on today. But in particular, you made mention of Martin's explanations relating to past, present and future in terms of identifying and recognising liabilities. And I really wanted to reiterate that point, particularly because this week could be an examinable topic. So when you come to your exam study, there will be an exam advice released in week 10. So when you do get the exam advice, if you see points on there, you might like to come back and re-familiarise yourself with the study guide. So Chapter 6, Liabilities, if you haven't already read it, please make the time to read it. It is a little bit of a longer study guide this week, but it's definitely well worth the read. That's all. Thanks, John.
Thanks, Maria. Martin, you have anything to add?
No, that's very good. We've had a bit of a discussion about provisions not being backed by cash here in Rockhampton. All liabilities aren't backed by cash. They're liabilities. The cash is an asset. So we've been talking about that. So that's great. Thanks, John.
Okay. Lois, anything to add?
All good. Thanks, John.
All right. That's excellent. All right. We're just about out of time. We'll all move on to the workshops now. Thanks, everyone, for participating today. It was a great exercise. All right. Bye for now.
Thank you, John.
Thank you, John.
Thanks, John.
Bye.
Bye.